So imagine you're running a business, right? And for every single dollar that comes through your door, 77 cents survives all your operating expenses. It just becomes pure pre-tax profit.
Yeah, that is a wild number.
Right. If you saw that, you'd probably assume you were looking at, I don't know, an illegal monopoly, or maybe a pharmaceutical company that just patented the cure for the common cold.
You definitely wouldn't think you were looking at a financial services company.
Yeah, exactly. A company operating in one of the most ruthlessly competitive, heavily regulated sectors on the planet. But today, we're going to look under the hood of a machine that is doing exactly that.
And that entity, operating at that staggering level of efficiency, is Interactive Brokers Group, ticker symbol IBKR.
And we're diving right in. Welcome to today's deep dive. We've got their Q2 2026 earnings call data, the executive commentary, and the analyst Q&A right in front of us.
Yeah, and analyzing this particular quarter is basically a masterclass in how a company can use automation to just completely decouple its revenue growth from its headcount.
For sure. But to set the stage for you, the listener, we need to talk about what an earnings call actually is. A lot of people treat these quarterly updates like, a perfectly transparent diagnostic tool.
Right. They think it's just going to give them a clean yes or no answer about the health of a company.
But stepping into the world of corporate finance, it's more like trying to read the dashboard of a car where the manufacturer has intentionally painted over half the dials.
That is a great way to put it. You have executives throwing out all these terms like adjusted EBITDA, projected run rates, macroeconomic headwinds.
Exactly. The language is often designed to obscure rather than illuminate. So our mission for this deep dive is to basically scrape the paint off those dials. We are going to translate Wall Street corporate speak into plain, actionable language.
We're getting in, extracting the numbers, the story driving them, the guidance, and most importantly, what it all means for your portfolio.
Interactive brokers is just a fascinating subject for this kind of translation, mostly because of their sheer scale.
Yeah. The scale is jarring, especially if you only interact with retail finance through like a simple gamified app on your phone.
Right. They operate globally, catering to everyone from the individual retail investor trading fractional shares all the way up to massive quantitative hedge funds.
And they've been doing this, iterating on this electronic brokerage model since 1977.
So let's start by looking at the pure output of that model in the second quarter of 2026. The headline numbers are just aggressive. Net revenues and pre-tax income hit all-time record highs.
But that 77% pre-tax profit margin, that's the number that demands immediate attention.
Wait, and this isn't some weird one-off anomaly, right?
No, not at all. It's not a situation where they, sold a massive piece of commercial real estate and artificially spiked their quarterly income. This marks their 8th consecutive quarter with margins above 70%.
Wow. 8th consecutive quarter.
Yeah, and their 7th consecutive quarter with margins of 71% or higher.
Just think about the mechanics of operating a business at a 77% margin. In almost any other industry, whether it's an airline operating at single-digit margins because of fuel and labor, or even like a typical SaaS tech company aiming for 20% to 30%, a 77% pre-tax margin is functionally unheard of.
It really is. It means that after paying for the servers, the regulatory compliance, the marketing, the staff, 77 cents of every dollar is retained before the tax bill comes due.
It points to a business architecture that just does not require proportional spending to support new revenue. So let's follow the money to see exactly how they are feeding that architecture.
Okay, looking at the revenue drivers, their commissions rose 30% compared to the second quarter of last year.
Which set a brand new record for the firm, by the way.
Yeah, but the true heavy hitter on the balance sheet is net interest income. That metric jumped 23% year over year, coming in at over $1 billion.
$1 billion generated in a single 3-month period just from interest.
Exactly. And net interest income is a critical metric to define because it explains the hidden engine of modern brokerages.
Right. Can you break that down for us?
Sure. Broadly speaking, it's the money a broker makes on the cash they're holding, minus the interest they pay out to their customers for keeping that cash on the platform.
So when a client sells a stock and leaves the cash sitting in their account waiting for the next opportunity, the broker doesn't just put that money in a digital vault.
No, not at all. They sweep it into interest-bearing vehicles like short-term treasury bills or deposits at partner banks earning a yield. Then they pass a portion of that yield back to the client, and they keep the spread as profit.
And the raw material they have to work with here is massive. The data shows that client uninvested cash balances reached a record $182 billion.
That represents a 27% increase year over year.
Meanwhile, client equity overall, so the total value of all the stocks, bonds, options, and cash held on the platform, skyrocketed 40% to $930 billion.
They are knocking on the door of $1 trillion in client equity.
$1 trillion. And this isn't just asset appreciation, right? The actual user base is exploding.
Yeah, they reported 34% growth in new accounts. That translates to bringing 1.3 million new accounts onto the platform in a single year.
Okay, but we have to look at the macroeconomic environment in the second quarter of 2026. It provided an incredibly fertile ground for those numbers.
Oh, absolutely. Management explicitly pointed to the performance of the broader market. The S&P 500 was up nearly 15% in Q2, with markets rising aggressively through April and May.
And that kind of upward momentum naturally inflates client equity and attracts new retail investors who want to, participate in the rally.
But the data shows that the retail behavior was highly specific. Investors weren't just throwing money at the broad market index.
Right. The source material highlights a distinct shift away from the Magnificent Seven, those mega cap tech giants that usually suck up all the oxygen.
Instead, retail and institutional money aggressively rotated into semiconductor names. Those chip companies completely took over as the primary market drivers.
And they were among the most heavily traded names on the entire Interactive Brokers platform.
This rotation really highlights a crucial differentiator for their user base. It demonstrates thematic, highly targeted capital allocation.
So they're looking past the initial layer of AI software companies and pricing in the physical infrastructure layer, the hardware and memory chips.
Exactly. The picks and shovels of the AI gold rush.
I do have to pause and play devil's advocate here, though. We're looking at a quarter where the S&P 500 is up 15%. That is a massive macroeconomic tide lifting every single boat in the harbor.
It is.
So how much of these stellar numbers, the record commissions, the $1 trillion in equity, the account growth, how much of this is simply a result of IBKR casually surfing a massive market wave?
That's a fair question.
Right, because if the entire market is in a state of euphoria, any competent brokerage is going to print money. How do we know this is deliberate business execution rather than just sheer luck?
Well, that is the exact analytical filter you must apply to any earnings call. Mm-hmm. A rising market can mask profound operational inefficiencies. But the evidence that points away from passive luck and toward active execution lies in a metric called DARTs, Daily Average Revenue Trades.
Which measures exactly what it sounds like, right? The number of trades executed per day that generate commission revenue.
Yeah, and the volume is staggering. Total customer DARTs hit 4.8 million trades per day in the quarter.
4.8 million per day.
Yep. That represents a 36% spike from the prior year.
Yep.
Think about it. If the client base was simply passively riding the 15% S&P 500 wave, meaning they bought an index fund in January and went to sleep.
You'd see client equity rise, sure.
Right. But you would not see daily trading volume explode by 36%. The platform engagement is kinetic. Clients are actively reacting to news, rebalancing, and rotating capital daily.
And they're utilizing leverage to do it. The chief financial officer, Paul Brody, pointed to robust growth in margin borrowing. He noted that it reflects a distinctly risk-on environment among their users.
Meaning people aren't just trading their own cash. They are actively borrowing money from Interactive Brokers to amplify their purchasing power.
And the mechanics of margin borrowing form the second half of that net interest income equation we discussed earlier.
Exactly. When a client borrows money to buy more stock than their cash balance allows, the broker charges them interest on that loan. According to the data, margin loan interest revenue was up 39% in the quarter.
Wow. So, addressing the devil's advocate scenario, yes, the macro environment is a tailwind, but IBKR is actively monetizing that volatility because their client base utilizes complex, high-frequency, leveraged strategies.
They aren't just passive buy-and-hold investors.
Right. Now, the cost of processing those 4.8 million daily trades brings up a fascinating structural quirk in the financial system. Brody noted that their execution, clearing, and distribution costs were $142 million, which was a 22% increase.
But he specifically isolated a $34 million line item in that increase, attributing it to the reinitiation of SEC regulatory fees.
My read on this is that the Securities and Exchange Commission suddenly handed them a massive $34 million bill. But Brody insisted this doesn't actually impact their profitability at all. How does a company absorb the $34 million regulatory cost without it hurting the bottom line?
They absorb it through the mechanics of pass-through billing. To understand this, we have to look at Section 31 of the Securities Exchange Act. It allows the SEC to collect fees on securities transactions to fund its regulatory operation.
Yep.
Historically, this fee is a fraction of a cent per transaction. Apparently, these fees had been set to zero since the middle of Q2 2025. It was essentially a temporary holiday for the industry.
Ah, okay. And when the SEC turned the fees back on in 2026, the cost immediately appeared on IBKR's balance sheet.
Right, but they don't actually pay it out of their own pockets.
Because they just pass it on to the user.
Precisely. In a pass-through structure, the broker acts purely as a collection agent. When a client executes a trade, the broker calculates the exact fraction of a cent owed to the SEC for that specific trade and adds it as a separate line item to the client's commission fee.
So they collect the fee from the client and hand it directly to the SEC.
Yep. Therefore, commission revenue increases by the exact same $34 million that execution costs increase. The net effect on the profit margin is mathematically zero.
Which means if you strip away the optical illusion of those SEC pass-through fees, the raw underlying cost of executing 4.8 million trades a day only went up by 7%, rising from $101 million to $108 million.
And that level of cost control yields what they call a gross transactional profit margin of 83%.
That is wild. That 83% gross transactional margin has to be the direct result of their engineering-first culture.
Oh, absolutely. Every time they route an order, clear a trade, or settle a transaction, the marginal cost of doing so approaches zero because a machine is handling the entire life cycle of the trade.
And that brings us to the human element, or rather the lack of it. Let's look at the headcount required to operate a global platform managing nearly $1 trillion in assets and processing nearly 5 million trades a day.
This is where it gets really interesting.
As of June 30th, their total employee count was exactly 3,265.
The ratio of assets under management to human employees is just the defining characteristic of this company.
It fundamentally breaks the traditional Wall Street model. I mean, if you look at legacy banks or traditional full-service brokerages, managing $1 trillion requires armies of financial advisors, customer service reps, regional managers, back-office compliance staff.
But here, the total compensation and benefits expense for the entire quarter was only $182 million.
That means their human resource costs account for merely 10% of their adjusted net revenues.
And that efficiency is accelerating. Last year, it was 11%. As the revenue goes up, the percentage eaten by human capital is shrinking.
This is the holy grail of infinite scalability. Management has explicitly stated that their core business strategy is automating every conceivable point of friction in the brokerage lifecycle.
And it works. If you construct a systemic architecture based on automated routing protocols and self-service digital onboarding, you can absorb 1.3 million new accounts in a single year without having to build a new call center or hire thousands of support staff.
The software scales instantly. The human element does not.
Exactly.
So we know the balance sheet tells us they're operating an impossibly lean, highly automated, immensely profitable machine. But the balance sheet only tells us what happened. To understand why 1.3 million new users decided to move their capital to this specific platform, we have to look at the global expansion and the product roadmap.
Yeah, the underlying story of Q2 2026 is an aggressive, multi-front campaign to give retail investors institutional-grade access to global markets.
They aren't waiting for clients to request access. They are proactively laying the plumbing to entirely new financial ecosystems.
And the clearest example of that plumbing is their expansion into South Korea.
Right. The CEO, Milan Galik, announced that they became the very first electronic broker to offer direct trading in the Korean market. But what I found fascinating is the structural mechanism they used. They didn't just wire into the traditional Korea stock exchange.
No, they also plug their clients into Nextred, which operates as an alternative trading system, or ATS, offering 12-hour and overnight trading.
Why is that ATS so important mechanically?
Because a traditional exchange, like the New York Stock Exchange or the Korea Stock Exchange, operates as a public, lit market with strict, centralized trading hours.
Right, the opening and closing bells.
Exactly. An ATS, however, is an electronic venue that matches buyers and sellers outside of that traditional exchange infrastructure. By utilizing an ATS in Korea, they bypass the rigidity of the legacy exchange hours, offering continuous liquidity.
And the timing of this Korean expansion perfectly aligns with the retail obsession with the semiconductor sector that we discussed earlier. South Korea is effectively ground zero for some of the most critical memory chip manufacturing on the planet.
The perfect synergy. Gaelic confirmed that the moment they turned the key and opened access to Korea, their clients aggressively flooded into those specific memory chip companies.
But the demand for direct, localized access is immense. An analyst on the call posed an interesting structural question regarding this. They noted that an American depository receipt, or ADR, for a major Korean stock had recently launched in the U.S. markets.
Right, and they wanted to know if that cannibalized the local trading.
Exactly. Let me make sure I understand the mechanics of an ADR first. If I'm an investor in Chicago, buying shares directly on the Korea Stock Exchange means dealing with foreign currency conversions, different settlement rules, time zone issues.
A lot of friction.
So an ADR is essentially a certificate issued by a U.S. bank that represents a specified number of shares in that foreign stock, and it trades on the New York Stock Exchange in U.S. dollars, just like a regular stock. It removes all that cross-border friction.
That is the exact mechanism.
Yeah.
So the analyst's assumption was that once the friction-free ADR became available in New York, clients would just stop navigating the complex direct Korean market.
But Gaelic completely rejected that premise. He stated that from day one of the Korean launch, the volume was a straight lineup. When the ADR launched, it didn't cannibalize the local volume at all. It just added cumulative incremental volume on top.
It really proves that sophisticated retail and institutional clients actually want the granular control of direct market access. They don't just want to rely on U.S. packaged derivatives.
And they applied that same philosophy of direct democratized access to the European market, specifically regarding the SpaceX initial public offering.
Oh yeah, this is a massive move. Management noted they directly offered the SpaceX IPO to eligible retail clients across the UK and Europe.
The mechanics of how IPOs traditionally operate make this a massive competitive moat. Historically, an IPO is treated like the VIP room of an exclusive club.
So true.
When a highly anticipated company goes public, the investment banks managing the offering allocate the shares at the IPO price to their biggest institutional clients, the massive mutual funds and pensions. The individual retail investor is locked out of that primary allocation.
They have to wait until the stock begins trading on the secondary public market.
And by that point, the price is usually already spiked 20% or 30%. The retail investor historically absorbs the premium created by the institutional investors.
But by leveraging their global scale, Interactive Brokers negotiated direct primary access for European retail clients. Think about that. If you are an active investor in London or Frankfurt and your legacy, domestic brokerage cannot secure you an allocation to the SpaceX IPO.
But a global platform like IBKR can.
Exactly. The incentive to transfer your entire portfolio to that platform becomes overwhelming.
They are also pushing the boundaries of access in the cryptocurrency space. They expanded crypto offerings throughout Europe, building on the framework they established in the UK back in 2024.
But during the Q&A, a highly technical discussion emerged regarding a specific product called perpetual futures.
Right. An analyst pressed Gaelic on the demand for these instruments, and Gaelic noted that they rely on global volume data to dictate their product roadmap, leading them to offer crypto perpetuals in partnership with Coinbase.
Now, my understanding of a perpetual future is that it's exactly what the name implies. A futures contract that has no expiration date.
Yeah. Traditional futures contracts in commodities or equities force you to settle the trade or roll the contract over on a specific Friday of the month. A perpetual contract can theoretically be held forever.
But mechanically, if a contract never expires, how do they force the price of the contract to stay tethered to the actual real-time price of Bitcoin or Ethereum?
That is the genius of the perpetual futures mechanism. It relies on something called the funding rate.
The funding rate, okay.
Because there is no settlement date to force the derivative price to match the spot price, the exchange utilizes a continuous automated payment system between the buyers and the sellers.
How does that work in practice?
Well, if the price of the perpetual contract climbs slightly higher than the actual spot price of Bitcoin, the system charges a small recurring fee to the people holding long positions, and it pays that fee to the people holding short positions.
Ah, so it incentivizes more people to short the contract, driving the price back down into alignment with the spot market.
Exactly. It is a self-correcting financial mechanism running 24/7.
Okay, so the mechanism is elegant. But why go through the complexity of trading a perpetual derivative instead of just buying the underlying Bitcoin and holding it in a digital wallet? What friction does this actually solve for the client?
It solves the friction of directional flexibility and capital efficiency. As Gaelic accurately pointed out, interacting with raw, spot cryptocurrency presents two massive logistical hurdles for a sophisticated trader.
Which are?
First, shorting spot crypto betting that the price will crash is mechanically complex and often expensive, requiring you to locate and borrow the underlying digital asset. Second, applying significant leverage borrowing capital to amplify your exposure is highly restricted in standard crypto spot markets.
And perpetual futures solve both issues instantly.
Yep. You can enter a short position with the click of a button, and the exchanges allow you to apply substantial leverage to the trade.
And the adoption rate proves the utility, doesn't it? Gaelic revealed that roughly 1/3 of all the cryptocurrency trading volume they process is now originating from these perpetual futures.
1/3. That is a massive volume of capital migrating toward a complex derivative. It just further demonstrates that their user base leans heavily toward advanced institutional-style mechanics rather than simple spot accumulation.
And this appetite for continuous global access perfectly explains the massive structural shift we are seeing in the overnight trading boom.
The concept of market hours, the traditional 9:30 a.m. to 4:00 p.m. Eastern Time window, is rapidly becoming an antiquated relic of the 20th century.
It really is. The expectation of modern digital commerce is immediate execution. The financial markets are being forced to adapt to the realities of a digitized, globally connected capital base.
The data on this is unequivocal. Interactive Brokers reported that their overnight trading volumes nearly tripled year over year during the second quarter.
Tripled. They processed 3.8 million overnight trades last year. This quarter, that number exploded to 10.9 million.
Mechanically, maintaining a liquid market while the primary exchanges in New York are asleep requires a sophisticated network of market makers and alternative trading venues.
And that volume is heavily driven by international demographic shifts. If an investor located in Singapore or Geneva wishes to trade U.S. equities based on breaking geopolitical news in their own time zone,
forcing them to wait 14 hours for the ringing of the bell at the New York Stock Exchange introduces unacceptable market risk.
It's the ultimate democratization of time. They can react in real time.
Speaking of reacting to real-time events, let's look at a product launch that generated significant discussion on the call: prediction markets.
Oh, this was fascinating.
They rolled out a unified destination known as IBKR prediction markets, allowing clients to trade what are formally called event contracts.
Now, my understanding of an event contract is that it strips away the underlying asset entirely. You aren't buying a share of a company or a barrel of oil. You're taking a financial position on the specific outcome of a future event.
Right. It pays out a fixed amount if the event happens and goes to zero if it doesn't.
The underlying mechanics rely on aggregate human probability. To achieve this, IBKR didn't build their own proprietary exchange. Instead, they aggregated access across 3 of the largest regulated event exchanges: ForecastX, the CME, and Kalshi.
Exactly, and execute the client's trade on whichever exchange offers the most favorable net pricing.
Exactly, and execute the client's trade on whichever exchange offers the most favorable net pricing.
The routing architecture is impressive, but what really captured my attention was the strict philosophical boundary management established here.
What do you mean?
During the Q&A, an analyst probed the strategic rationale behind this launch. Gaelic was incredibly definitive in his response, stating explicitly, "We still do not offer sports. We still do not offer entertainment contracts."
Which is a huge distinction.
Right. Why draw that line? In a world where digital sports betting is a multi-billion-dollar industry, why would a broker built on processing massive transaction volume intentionally turn away from that revenue stream?
Well, they draw that line to preserve the structural integrity of the platform. They want it to be a venue for risk management rather than a venue for recreational gambling.
That makes sense.
There is a profound mechanical difference between betting on the outcome of a football game and utilizing a financial derivative to manage economic exposure. An entertainment contract offers no economic utility beyond the thrill of the wager.
But by deliberately excluding sports and entertainment, management ensures that regulators and institutional clients view these prediction markets strictly as legitimate hedging instruments.
Exactly. The primary focus is entirely on economic indicators, geopolitical shifts, and climate events that have a tangible mathematical impact on a client's core portfolio.
The example discussed on the call was brilliant in its pragmatism. An analyst inquired about a noticeable concentration of open interest in weather-related contracts on the ForecastX exchange. Gaelic explained that they are facilitating the trading of contracts based on potential hurricane landfalls.
Let's put you, the listener, in the shoes of a portfolio manager to understand the utility of this.
Okay, let's do it.
Imagine you manage a massive portfolio heavily concentrated in coastal commercial real estate investment trusts. Or perhaps you hold significant equity in property and casualty insurance companies with deep exposure to the Florida coastline.
Right, so a Category 5 hurricane is a massive, unhedgeable risk event within the traditional stock and bond markets.
But if you buy an event contract that pays out a specific cash value if a hurricane makes landfall in a designated geographic zone, you aren't gambling.
You are mechanically engineering a customized insurance policy that injects liquid cash into your portfolio at the exact moment your real estate equities suffer a drawdown.
It is the purest distillation of risk transfer. They take a mechanism that mimics the binary structure of a wager and deploy it as a precision instrument for capital preservation.
And they are applying that same binary logic directly to the equities market by offering trading in the CBOE's new binary options.
Binary options operate on a ruthlessly simple mechanical premise. A traditional options contract gives you the right to buy or sell an asset, and its value fluctuates dynamically based on a myriad of variables like time decay and implied volatility.
Right, it's complicated math.
But a binary option asks a single question with a yes or no answer. For example, will the S&P 500 close above a specific index level at exactly 4:00 p.m. on Friday?
So if the strike level is set at 5,500 and the index closes at 5,501 cent, the option pays out its maximum predetermined value.
Yep, and if it closes at 5,499.99 cents, the option expires completely worthless.
It's an all-or-nothing payout structure designed for high-frequency, precision targeting of market levels, stripping away the complex calculus of traditional option pricing.
The theme here is clear. Interactive Brokers is building an ecosystem that caters to highly sophisticated, globally mobile capital.
And that global positioning leads us directly to a fascinating geopolitical situation discussed during the call, demonstrating how a firm benefits from maintaining a fortress of regulatory compliance.
Oh, the Tiger and Futu situation.
Yes. The analyst community brought up the regulatory actions taken against Tiger Brokers and Futu. For context, Tiger and Futu are prominent online brokerages that built massive user bases by catering specifically to retail investors located in mainland China, allowing them to trade offshore U.S. equities.
However, in May of 2026, Chinese regulators executed a severe crackdown on these platforms. They essentially penalized them for soliciting accounts and facilitating cross-border capital flows without the requisite mainland license.
The mechanics of cross-border capital controls are incredibly complex, particularly regarding China's State Administration of Foreign Exchange. Regulators effectively paralyzed the growth engines of IBKR's primary competitors in the Asian market.
The critical question posed to Gaelic was how this sudden regulatory vacuum impacted Interactive Brokers' operational metrics.
Gaelic's explanation was essentially a masterclass in how playing by the strictest possible rules eventually yields massive dividends. He detailed their historical compliance posture, stating emphatically that IBKR does not, and has never, advertised its services within mainland China.
Furthermore, their automated onboarding mechanics require rigorous verification that a prospective client maintains a legal, verifiable residence entirely outside of the mainland before they are permitted to open an account or fund a wallet.
They engineered their compliance architecture to be impervious to the specific regulatory breach that crippled Tiger and Futu.
And the market rewarded them for that stability. Because they operated within the boundaries of the law, they were perfectly positioned to absorb the capital flight resulting from the crackdown.
Gaelic confirmed that as a direct mechanical consequence of the regulatory actions against Tiger and Futu, IBKR witnessed a quantifiable immediate spike in automated broker-to-broker asset transfers.
Clients despise regulatory uncertainty above all else. When a brokerage platform comes under the scrutiny of state authorities, the immediate reaction of sophisticated capital is to migrate to a heavily fortified, compliant alternative.
Gaelic noted a specific behavioral trend, right? Individuals who already maintained secondary or dormant accounts with Interactive Brokers initiated full ACCAT transfers.
Yeah, moving their remaining capital away from the targeted platforms and consolidating their entire net worth onto IBKR's infrastructure.
It is the definition of regulatory arbitrage. When your competitor violates the rules of the game and gets penalized by the referee, the most structurally sound player on the field automatically inherits their market share.
That structural soundness is going to be tested, however, by the final major technological initiative detailed in the call.
This is where the transcript moves from current operations into the realm of paradigm-shifting future technology. I'm talking about the AI factor, specifically the rollout of the IBKR connector.
They announced live integrations with three of the most powerful large language models on the planet: OpenAI, Anthropic, and xAI.
The way I conceptualize the mechanics of this integration is by picturing a hyper-intelligent financial co-pilot embedded directly into the user interface.
An investor can utilize natural conversational language to instruct the AI to analyze macroeconomic data, screen a portfolio for sector vulnerabilities, and draft the precise global equity and options orders required to rebalance the portfolio.
However, there is a hard-coded safety protocol. The AI is physically incapable of transmitting the order to the exchange. It queues the trades up on the screen, but the system requires the human operator to manually authenticate and approve the execution.
The term Gaelic used to define this architecture is the human-in-the-loop paradigm. It is a critical risk mitigation mechanism designed to democratize automated trading while preventing algorithmic catastrophes.
To fully grasp the significance of this, we must examine the historical mechanics of API access.
Right. An API, or Application Programming Interface, is essentially the digital bridge that allows two independent software programs to communicate and exchange data in real time, bypassing the visual user interface entirely.
And for over a decade, Interactive Brokers has provided an incredibly robust API to its institutional clients. A quantitative hedge fund or a sophisticated coder could write thousands of lines of code in Python or C++ Mayer, plug that code directly into the IBKR API, and allow their algorithms to trade autonomously at microsecond speeds.
However, that capability was gated by technical literacy. You had to be a software engineer to utilize it, which meant you fundamentally understood the mathematical logic dictating the machine's behavior because you physically authored the code.
But the integration of large language models shatters that technical barrier. Suddenly, a retail investor with zero coding experience can simply open a chatbot and type, "Analyze the upcoming Fed rate decision, calculate the optimal ratio of short-duration treasuries to mega-cap tech stocks, and execute the rebalancing."
And the LLM acts as a real-time translator, converting that natural language prompt into the complex API calls required to interact with the brokerage's routing engine.
And that translation layer introduces a massive systemic vulnerability known as algorithmic hallucination.
Right. Large language models are predictive text engines. They do not possess an inherent understanding of financial risk. The general public finds it frictionless to converse with these models, but because the human user did not write the underlying API code generated by the prompt, they remain largely blind to the sequential logic the AI intends to execute.
Which explains Gaelick's extreme caution. He explicitly stated during the call that management must ensure the chatbot does not run away from them and generate a lot of bad trades.
If an AI hallucinates a data point and decides to aggressively short a volatile tech stock using maximum margin leverage, it could obliterate a retail client's net worth in a matter of milliseconds.
Hence, the human in the loop. The system forces a mandatory pause, requiring the human to visually inspect the AI's logic and assume legal and financial responsibility for the trade before the data is transmitted to the exchange.
Despite the friction of that mandatory pause, the internal data indicates explosive demand for the capability. Management observed clients actively discovering and connecting their personal AI environments to their IBKR accounts before the company had even issued a formal press release.
The mere presence of IBKR in the integration drop-down menus of these AI platforms triggered immediate adoption.
It reveals a massive pent-up appetite among retail investors to weaponize institutional-grade AI analysis against the broader market.
That appetite for innovation leads us directly into the analysis of management guidance. We have dissected the mechanics of what happened in Q2 and the technological story driving those metrics. Now we have to examine what the executive team is signaling about the structural future of the firm.
The first massive signal is the sheer size of their balance sheet reserves. The CEO confirmed they are currently sitting on a war chest of $10.3 billion in excess capital.
Just sitting there.
To clarify the terminology, excess capital represents liquid reserves held above and beyond the stringent regulatory buffers, clearinghouse requirements, and daily operational liquidity needs mandated by global financial authorities. It is pure, unencumbered surplus.
And that surplus increased by a staggering $1.1 billion sequentially from just the previous quarter.
So they have over $10 billion sitting in the vault with no immediate operational mandate. Naturally, the analyst community, heavily populated by investment bankers, began probing for M&A activity, mergers, and acquisitions.
Because when a company holds that much excess capital, the traditional Wall Street playbook dictates that they should use it to acquire a competitor, expand their geographic footprint, or buy a shiny new technology startup.
Gaelick's response to the M&A inquiries was wonderfully dismissive of that traditional Wall Street ecosystem. He noted that their inbox is perpetually flooded with pitch decks from investment banks aggressively trying to broker a sale and collect a commission.
Yet, despite the sheer volume of targets presented to them, Gaelick stated plainly that management has seen absolutely nothing worthy of pursuing.
It is a profound demonstration of operational discipline. When your internal engineering team has constructed a platform that organically generates a 77% pre-tax profit margin, executing a multi-billion-dollar acquisition of a legacy brokerage operating at a 30% margin makes zero mathematical sense.
Absorbing a competitor would force them to integrate antiquated, inefficient technology stacks and bloated payrolls, ultimately diluting the pristine efficiency of their own automated systems.
They refuse to buy superficial revenue growth at the expense of their core operational philosophy.
They are content to organically construct the infrastructure they require. A prime example of this internal building philosophy is their pursuit of a national trust bank charter.
Management, specifically Nancy Stubb, updated the market that they had received preliminary conditional approval from the Office of the Comptroller of the Currency, or OCC, and anticipate the charter being fully operational by the end of the year.
Let's break down the mechanics of a national trust bank charter. Why does an electronic broker need to become a chartered bank?
It fundamentally alters their infrastructural capabilities regarding asset custody. Currently, to service massive institutional clients like mutual funds, endowments, or ETF providers, Interactive Brokers likely has to utilize third-party custodial banks to officially hold and safeguard the underlying assets.
And interfacing with an external custodian introduces operational friction, latency in settlement, and most importantly, external fees that eat into the profit margin.
Exactly. By securing their own OCC charter, they become the custodian. They internalize the entire life cycle of the asset, from the initial trade execution and routing to the final clearing and long-term storage in the vault.
They eliminate the middleman, driving their operational costs even closer to zero and presenting a seamless end-to-end solution to the most heavily capitalized institutions on the planet.
However, all of this internal efficiency and technological innovation is ultimately held hostage by a macroeconomic variable entirely outside of management's control: global interest rates.
We analyzed the mechanics of how they generated over $1 billion in net interest income this quarter. But that money printer relies on central banks maintaining a high-yield environment.
The sensitivity to interest rates is the paramount risk factor for the underlying business model. What elevates this earnings call above the industry standard is the profound transparency management provided regarding that exact risk. Paul Brody did not offer vague platitudes. He delivered precise mathematical modeling.
Brody outlined a specific sensitivity analysis based on their June 30th balance sheet. He stated that if the United States Federal Reserve were to increase the benchmark Fed funds rate by a mere 25 basis points, which is exactly 0.25%, Interactive Brokers' annualized net interest income would mechanically increase by $81 million.
The leverage is astonishing, and the mathematical inverse is equally brutal. A 25 basis point reduction by the Federal Reserve would trigger an automatic $81 million decrease in their annual net interest income.
So for every single 0.25% tweak executed by the Fed, IBKR's bottom line swings by $81 million, and their exposure is not limited to American monetary policy.
Brody detailed that approximately 1/3 of their interest-sensitive balances are held in foreign currencies. Consequently, a parallel 25 basis point shift in the relevant non-USD global benchmark rates would generate an additional $38 million swing in their annual income.
The mechanics of the yield curve dictate their profitability. Their massive reserve of uninvested cash means they possess an automatic license to print capital in a high-rate inflationary environment.
However, if macroeconomic data dictates a coordinated, sustained rate-cutting cycle by the Federal Reserve, the European Central Bank, and the Bank of England, that $1 billion quarterly interest revenue engine will face a massive, unavoidable mathematical drag.
Management cannot engineer their way out of a zero interest rate environment,
which forces them to rely on pure account growth to offset any future decline in interest rates.
Yeah.
And this leads to a remarkably candid exchange regarding their marketing strategy.
Right. An analyst noted that the firm recently hired a new chief marketing officer and aggressively expanded their marketing budget. Coinciding with this increased spend, their new account growth rate spiked to 34%, which is significantly higher than their historical normalized baseline growth rate of 20%.
The analysts essentially asked management if this elevated marketing spend fundamentally altered the trajectory of the company and whether investors should expect growth to remain permanently elevated above that 20% floor.
It was at this moment that Thomas Peterffy, the founder and chairman of the company, intervened to answer the question. His response dismantled the standard corporate playbook of perpetually hyping forward projections. He stated, point blank, "I do not think that the marketing yield has in fact been higher than it used to be. It is roughly the same."
The mechanics of marketing yield represent the return on investment for advertising dollars. Peterffy explicitly confirmed that while they spent a significantly larger amount of money to acquire a larger absolute number of accounts, the underlying efficiency of the marketing engine did not miraculously improve. The growth was purely proportional to the spend.
It is a stunning admission of reality. Peterffy refused to allow the analysts to extrapolate a temporary spike in growth into a permanent structural advantage.
He reinforced this conservatism by sharing a historical anecdote, recalling a moment years prior when he publicly promised 30% sustained growth, only to watch the actual rate immediately plummet to 20%.
He explained that from that moment forward, the executive team resolved to conservatively guide the market to expect a 20% baseline, even during quarters where they were actively executing at 30% or 40%.
It establishes a culture of underpromising and over-delivering, insulating the stock from the violent volatility that occurs when a tech company misses an artificially inflated internal projection.
There is one final piece of guidance we must examine, and it brings us back full circle to the mechanics of artificial intelligence. We discussed the human-in-the-loop safety protocol, where the client must manually approve the AI's trading logic.
But when pressed by analysts on the future of this architecture, Gaelic conceded that a fundamental paradigm shift is inevitable.
Gaelic confirmed that the ultimate destination of their development roadmap is the deployment of fully autonomous agentic AI trading.
This means engineering an environment where the large language model possesses the authority to independently analyze market data, formulate a strategy, and execute the trades instantly, completely bypassing the requirement for human authorization.
But the mechanics of removing that safety rail are terrifying. Gaelic emphasized that before they release an autonomous agentic engine onto the live market, they will implement rigorous mandatory educational guardrails.
They intend to require clients to pass a formalized testing module, verifying that the user comprehends not just the theoretical benefits, but the catastrophic financial dangers of allowing an AI complete, unmonitored control over their capital.
The technology is coming, but management is acutely aware of the existential risk posed by algorithmic hallucinations running unchecked in a highly leveraged portfolio.
We have dissected the aggressive top-line numbers, the mechanics of their global expansion, the integration of new derivative products, the regulatory arbitrage in Asia, the AI paradigm shift, and the brutally honest management guidance regarding interest rates and marketing yields.
It is time to synthesize this data into a final verdict. We have translated the corporate X-ray. What does the fundamental architecture of this machine mean for you, the retail investor or the portfolio manager evaluating the stock?
Synthesizing the structural mechanics we have explored today leads to a decisively bullish underlying thesis.
Let's clearly define the mechanics of the bull case.
The bull thesis is anchored by three impregnable structural pillars. The primary pillar is their unparalleled operational leverage. Engineering a financial institution capable of maintaining a 77% pre-tax profit margin while managing nearly $1 trillion in client equity with a headcount barely exceeding 3,000 employees creates a defensive moat that legacy brokerages simply cannot breach.
Their absolute commitment to automating every microsecond of the trade life cycle yields infinite scalability.
The second pillar is their dominant capture of global market share through regulatory compliance and direct market plumbing. They possess geographical diversification. When regulatory authorities neutralize competitors in mainland China, IBKR's compliant infrastructure automatically absorbs the displaced capital.
When sophisticated capital demands access to 12-hour Korean alternative trading systems, IBKR engineers the digital bridge.
The third pillar is their velocity of product innovation. They are proactively building the infrastructure for the next decade of capital allocation, securing direct retail access to European IPOs like SpaceX, constructing a unified routing engine for real-world risk hedging via prediction markets, and directly integrating OpenAI and Anthropic into the user interface.
These are complex, institutional-grade mechanisms that act as a gravitational pull for the most active, highly capitalized traders on the planet.
The structural advantages are immense. They're a globally diversified, ruthlessly efficient technology company that happens to operate a brokerage.
But the diagnostic X-ray is never entirely clean. We must analyze the opposing forces. What are the mechanical bearish risk factors that threaten the integrity of that 77% margin?
The absolute primary bear risk is their mathematical tethering to global macroeconomic interest rates. If you adopt a bullish position on the operational excellence of this firm, you must simultaneously acknowledge that over $1 billion of their quarterly revenue is effectively a macro-environmental subsidy generated by the current high-yield environment.
As the management team transparently modeled, if global central banks initiate a coordinated, aggressive rate-cutting cycle in response to cooling inflation, the mechanical drag on their earnings will be immediate, severe, and entirely unhedgeable.
Furthermore, you must monitor the velocity of account growth. Thomas Petervey was exceptionally honest in stating that their marketing yield has not fundamentally improved. If the current macroeconomic euphoria subsides, or if the retail fascination with semiconductor momentum wanes, the platform's ability to maintain that 34% growth rate will be severely tested, and the market may punish the stock if growth reverts to the historical 20% baseline.
It presents a fascinating paradox. They possess near-perfect execution on the variables they control, but they remain heavily exposed to the decisions made by central bankers in Washington and Frankfurt.
Exactly.
As we conclude this deep dive into the mechanics of interactive brokers, I want to leave you, the listener, with a final theoretical scenario to analyze. It builds upon the technological roadmap management laid out, but pushes it to its illogical and perhaps unstable extreme.
Oh, this should be good.
Management explicitly confirmed that fully autonomous agentic AI trading is currently under development. The human-in-the-loop safety protocol is a temporary measure. Eventually, the guardrails will be removed.
Right.
I want you to mentally fast forward 3 or 4 years. Picture a digital ecosystem where millions of retail investors globally authorize highly trained, hyper-aggressive personal AI agents to operate completely off the leash. Picture these millions of autonomous bots unleashed into the dark pools of overnight Asian trading, or aggressively deploying capital into prediction markets to hedge against climate anomalies at microsecond speeds.
A wild thought.
When a decentralized army of retail AI agents ultimately clashes with the billion-dollar supercomputers operated by Wall Street institutions in the unregulated hours of the overnight market, who actually wins that algorithmic arms race? And more profoundly, when the entire market is dictated by autonomous code fighting autonomous code, what happens to the fundamental stability of the global financial system itself?
Wow, that's something to think about.
Thank you for joining us on this deep dive. Keep questioning the underlying mechanics, keep searching for the structural reality behind the balance sheet, and we will see you next time.